Most exciting day is when I return my investors' money, and that day has happened. Here's one thing these guys did, these slick freaking guys. This is my first syndication, and so because I was so nervous that nobody will come up with money, I did an 80-20 split. The day of closing, the deal is dead. The community already sort of made a conclusion about it being a messed up place. That was a lie, and that's, my friends, is the power of value-add investing. I don't want to sit and pay 16% for 5 years to my investors. I want to pay them off very quickly. So what we did, what I want to go over today is ultimately the case study of a deal we did and kind of give you everything from acquisition to financing to GPLP split to problems we had with tenants, with financing, last minute issues. I mean, the whole drama of this deal, right? I don't do business in Michigan. I don't know anybody in Michigan, right? And I meet my elite partner friend, Paul. And Paul's like, man, if you find anything in Michigan, I'd love to work with you. I'm like, all right, we're going to get to work. I said, Sean, find retail or industrial in Holland, please. I mean, in Holland, in Michigan. So he sets up the metrics and he looks for it. And he finds this beautiful property. I think asking price was $6 million or something. 100,000 square feet. Holland is a small town. It's like St. Cloud. It's got 100,000 residents within 5 miles. 125,000 square foot shopping center. It's got 4 buildings. You see the top picture right there? The red roofs? I mean, it feels like Holland. I loved it going there. So 4 buildings, a little lake in the front, and all the parking behind it. They said the NOI day one was 580. So I was like, 580 NOI, that's 9 cap in place income. We go to town, we offer 5.5, I think. We negotiate. Turns out the NOI was actually about 450. Here's one thing these guys did, these slick freaking guys. These guys sign a lease for 10,000 square feet on a vacancy, bump the NOI by 120,000, and think we're dummies, we're not going to miss it. So we look at the signature lines, right? The owner's name and the tenant's name are the same. So it's like, what the hell's going on here? Oh, my sister is going to open a retail store here. That was a lie. She never wanted to open a store. The whole place was messed up, but that was their hook to get us in. Having found that out, we got a $500,000 discount, but we didn't ask for a discount. We said, look, we don't want a discount. Give us a seller credit for $500,000. And they gave us a $450,000 seller credit. I'm like, all right, Sean, you got to fly out there. So Sean flies out there, stays there overnight, has a FaceTime, walks around, goes to jiu-jitsu, and he says, you know what? I like this town. It's nice. So we get under contract and we go to town. Paul Youssef and Rafik Moore are co-sponsors here, but I've never raised capital on syndications before this deal, by the way, you guys. This is my first syndication. Just so you know, before this, all I did was a one-on-one deal. I would have a friend, he gives me money, I buy buildings. It was a larger transaction. I would say we raised about $2 million total. And so because I was so nervous that nobody will come up with money, I did an 80-20 split. So 80% LPs, 20% GPs, 8 pref. 80-20, it's a really, really good deal for investors. Not a good deal for me and Paul because all we get is 10%. However, I said, guys, I will give you all your money back plus 16% on your money, and I'd like to reverse that to 60-40. And as long as you get your money back plus 16%, I'd like to be owner of a 60% of the property. And my people, investors agreed. I think we had 5 or 6 investors in there. After refinance of the property and them getting their money back, we get to a 60% GPs and 40% LPs. Now, I want you guys to put yourself on both sides of the equation. On the GP side first, and then the LP side second. So GP side, 80-20 split, 8 pref, 16% buyout. And so what happens here, to the extent that I will return all your money, Mr. Investor, give you 16% annualized on your money, I would like to get bonused, and for my 20% ownership, go up to 60% ownership. And that's what happened with the refinance ultimately. Now, all of our investors got 132% of their money back. So if you gave me $100,000 in September of 2024, you got $132,000 back last Friday or today, and you still own proportionally allocated 40% of your shares. So 5.25 purchase price, 450 seller credit. Effective price is 480, $42,000 per square foot is what we bought it for. Market rents for retail in that market was about 10 to 12 bucks a foot. 125,000 square feet. Corey, 10 bucks a foot. What is my stabilized NOI?
It's not 1.25?
Yeah.
1.5.
So if I buy a property, 125,000 square foot property, and my market rents are $10 triple net, my stabilized NOI would be 125,000 square feet multiplied by 10 bucks, which is $1.25 million. Multiplied by 95%, please. Who wants to multiply by 95? Why 95%? Because lenders and appraisers always use 5% vacancy factor. All right? So what's my stabilized NOI after the 5% vacancy, guys?
$1,187,000.
$1,187,000. Beautiful. All right. Now, Mr. Voikel, can you tell me what is the value of that property at 8 cap? If I were to sell it fully stabilized at 8 cap, tell me what that number is.
About almost 15 million.
15 million. So here's how it works. 95% occupancy, 1.187 is the NOI, divided by 8% cap rate, gives us a $50 million valuation. If I'm buying the building for 5 million, 4.8 million, and my rehab estimate is 2 to 3 million bucks, I have a pretty fat margin, right? Margin of error to get this done. Okay, $4.8 million purchase price, 1.83 we spent on rehab. We decided to leave another $800,000 in the rehab budget to finish all the construction. We have 3 units left, you guys. We got a 4,000 square foot unit, we got a 3,600 square foot unit, and we have a 1,600 square foot unit, totally left to remodel. And we spent about, we love our brokers. We pay our brokers very well. I think we paid close to $200,000 leasing commissions to stabilize it. So our approximate cost to stabilize this property was about $2 million. So 4.8 plus 2 million is 6.8. We could only get a $6.6 million mortgage on it with our banker 2 years later, and we had enough to pay off everybody else, okay? You're working with a new lender on a distressed asset. Most lenders who don't do distressed assets don't like them. They're scared of them. And so for us, I didn't know that these guys like stable assets. I'm going to work. I'm trying to prove to them that we can do it. The day of closing, the deal is dead. Imagine, you got earnest money, you got all these investors, everything signed, money's in the bank account. I got to go to closing. My first mortgage is not happening. I was freaking out. I'm like, dude, Paul, how much money you got? We needed $3 million to close. We had $2 million in the bank. Paul's like, I think I can pull together 1.5. I'm like, all right, I got to pull together 1.5. We'll close on it. So I'm basically trying to scrape some accounts and get ready to close, all cash. And then I call a favor with one of my bankers. And I say, hey, I have a full file. I got appraisal, everything, title work is done. Can you guys close on it? Is Rafik, we'll do it. We don't like to do business in Michigan. We've never done loans in Michigan, but for you, we will do it. And lo and behold, a week later on Friday, they closed on the loan, which is amazing. So always have a backup lender, whether it's a hard money lender, a private lender, or because these are stressful situations.
And them underwrite the deal as well?
We do a lot of these value add deals. Lenders know it. And there are specific lenders that specialize in rehab loans or bridge loans. They eat this up, the problem. Other lenders that are cheaper. So don't be cheap. Like I was trying to get a lower rate. Well, when you get a lower rate and these guys want to hold these properties long term, they'll underwrite the BGs out of it. They will discount all the short-term rents. They'll say if you have a short-term rental rate, it's a lease, there's a 50% chance they're not going to renew. And so they'll hit you with that basically a cash flow problem. And so that's how basically it works, all right? The property looked atrocious. It was peeling, paint was peeling, asphalt was destroyed, gutters are all destroyed. I mean, it just, and the problem people have is they want the property to make money, but they don't want to put money back into it because like our seller, they were just moved on. They didn't want to deal with this. And the property needed about $1 million of basically TLC. We spent $500,000-$600,000 on asphalt immediately after like within 3 months of buying it. And then we spent $200,000 to fix, repair, and paint the entire exterior. We replaced roofs, HVAC units, and that didn't even have any impact on the NOI. But as soon as we finished the work, it's like center woke up again from a slumber, from a being under like a bad spell. Everybody in the community knew it to be a dumpy mall with a bunch of homeless people hanging out there. There was some common area bathrooms, and we eliminated them because there's no need for common area bathrooms. Each retailer has a bathroom. But there's a bunch of loitering going on, and it just looks like a bad part of town. Now it's a really good part of town. We met Paul and I, and Paul did a great job. Paul actually carried 80% of this. I was not as involved in running the show as much as Paul was, but we had weekly calls, and Paul and I met with each individual tenant, try to understand what they need, try to serve them, and give them, like one tenant was paying $4,500 a month, and we said, look, can you extend? And they're like, well, we're not going to extend because the roof is leaking and HVAC doesn't work. And we said, HVAC and roof is going to cost us $50,000, but we're going to do it, fix it up. Can you pay slightly higher rent? So for $4,500 a month, we got them to $7,500, and now they're paying $8,000. And we did that with many tenants. We replaced doors, we fixed up their units, but ultimately that's how we lease vacancies. Now, after we remodeled everything on the outside, we went unit by unit and white shelled them so that they would be more appealing. We put garage door in one unit, and basically when you do that kind of stuff, units get leased up. I just want to make sure that you guys get it. There's a lot of retail place properties like this. We can create value. So leasing successes, daycare. There is a 6,500 square foot unit in the back, and when I walked in it, I've done a lot of daycares. I see a lot of daycares, and I'm like, dude, Paul, this is a perfect daycare. If we don't have a daycare, we have to knock all the walls and start over. But because this is laid out as daycare, let's go strategically and try to call on some daycare tenants and put a daycare tenant, and boom, miraculously, we found a daycare that's sponsored by the county, Ottawa County, and they are paying us about $6,400 gross, which is $8 triple net. The good thing about daycares, you guys, is that it brings a lot of parents in the morning, and then they come and they pick up their kids up in the evening. So it's creates a lot of traffic. And I think this daycare accommodates as many as 200 kids. So 200 parents potentially could come to our center. Orthodox Church, that was going on back and forth, 2 units in the back. The problem with the retail in the back, it doesn't see a lot of traffic, but the good thing about churches is that they are destination. And churches need a lot of open space, a lot of parking. And so these guys came in, they actually spent $50,000 on the space. I think we gave them $50,000, I don't recall specifics, but the church was really good. Golf simulator, 3,600 square feet. This is a franchise. He spent a lot of money on the space. That was really, really good. And then we had a 11,000 square foot antique store with a 75-year-old guy who ran that antique store for years. I think that antique store was there for 20 years or so. And the guy was sick, and he was trying to sell the antique store. We've talked to many antique store operators, and because we were trying to sell the business and get a new guy to run it. But ultimately, the deal didn't work out, and antique stores was paying $340 gross. $340 gross meaning our operating costs on the building about $340. He was paying operating costs only. I think he was paying for 11,000 square feet of space. He was paying $3,500 a month. And so Paul went touring the community, and he door knocked on a grocery store, Asian to be specific, and we got an 11,000 square foot Asian grocery store at $8 triple net. These guys spent $500,000 on our building. They put a commercial kitchen in there. I mean, these guys went all out. We gave them $150,000 also. So this space is nicely dialed in. It's a grocery store, and it totally transformed the center because it drives a lot of traffic. Grocery store, as opposed to antique store, drives more traffic because people want to buy groceries daily, weekly. Antiques, people don't really buy antiques, so it's kind of a dead destination. Dior nails. We found a guy who wanted to open a nail salon. And these guys, Chinese, really smart, maybe Vietnamese actually, very smart. And he's like, all right, I'll do it. Boom. Very easy to talk to. We negotiate. He says, I'll do everything myself. We come back. He spent $200,000. He totally decked the space out. All new tile on the floors, all new tile in the bathrooms. Really, really great LED lighting. Super sexy. And every time you go there, it's full. There's a lot of women and some men doing their nails. Planet Fitness, obviously, we released. That was a good success. Now, we did have some failures too, and we're dealing with the failure. So when you deal with value-add real estate, it's not always sunshine and rainbows, right? We leased 3,600 square feet to a tenant who went in there, and we spent some time, paid commissions, but they didn't make it. The traffic wasn't quite there. Had we put them today, it would have been better maybe, but when we put them in 24, she just couldn't get enough traffic to operate, and she called us up and said, look, I can't run it, I don't get enough traffic, and she bounced. Another problem we're having right now is jiu-jitsu guy. He's a really good guy, he's a good heart, we really want to help him out, but he's not a good business guy. And we expanded him to 10,000 square feet because he really, really wanted to, but he doesn't have any money to finish. And we gave him $50,000 for the tenant improvements, but he ran out of it. He doesn't have money to finish, so we said, look, what are we going to do? So he's trying to mortgage his house or sell a cabin or something to finish it. Paul and I are still on the fence about whether he's going to make it or not. The good thing is he's rent a 4,000 square foot jiu-jitsu spot for a long time in our center, so I know he can handle about $4,000 or $5,000 a month. Can he handle 10 grand? We don't know yet, but he's getting way more space, and he wants to expand it to MMA, and he wants to have a rink and everything else. So we said, look, worst case scenario, we'll chop him down into half the space and basically rent, because 10,000 square feet in the corner was really hard to lease. Worst case scenario, I said, if this guy doesn't make it, we can always shrink him down into 5,000 and deal with the 5,000 square feet in the front, which is going to be much easier to lease. And we're going to keep him in the back of the space. So currently about 92% occupied. NOI is about 843. Fully stabilized, NOI should be about $1 million. And we leased about 52,000 square feet of space. Now you guys know this, right? Property value equals to net operating income divided by cap rate. And we got a valuation of about $9.1 million from the appraiser. So if we were to sell the property today, we could probably sell it for about maybe $9.5 million bucks. If we are all in at 5 plus 7 and we sold it for 9, we would make $2 million in 2 years. Out of $2 million, Paul and I would have made $1.2 million, and our investors would make additional $800,000 on top of 16% that they got. And who's a really good math guy? If we were to sell this thing in 24 months at 9.1 million and our investors got $800,000 on top of their 16%, what kind of an IRR do you think they'll get? 2 million bucks plus 16% twice plus $800,000 on a $2 million in 2 years. So $400,000 on $2 million would be 20% per year. So 36%, it should be about 36%. So we had 72% LTV. Our mortgage payment is $45,000. If my payment is $45,000 a month and my NOI is $843, can you give me what the monthly cash flow is? Who's going to give me the first answer?
Around 400 something.
Monthly.
$27,000 a month.
$27,000 a month of cash flow. We still have 3 vacancies and everything is rented under market. By the way, did you notice that everybody's at $8 a foot? And I said market is 10 to 12, maybe even 14. The reason why we deliberately underpriced, when we talk to the brokers like, we can rent it at $12 to $14 triple net. The natural inclination from anyone is to try to get the highest number possible. Right? That's what anybody would do. That makes sense, right? Except then you're competing with every Dick and Harry in the market and you only get 1 out of 5 prospects because they go elsewhere. I don't want to sit and pay 16% for 5 years to my investors. I want to pay them off very quickly. So what do we do? What did we do? We decided to go under market, undercut everybody. And then if market is 10 to 12 bucks or 14 bucks and we had 8, everyone who's looking at space will look at our space first and see, why is it so cheap? And most people in that community knew it's a dumpy, forgotten, disgusting place. And so we already have a bad reputation. Many people didn't want to go there. If somebody said, if some realtor or broker said, hey, do you guys want to consider Holland Town Center? Nah, let's not go there. It's junk. But if it's $8 a foot, they might say, well, I might consider it because, and then they go and it's a completely different story. Boom, we close them. That's the secret. Anytime you buy a distressed asset, anytime you buy a value-add property, the community already sort of made a conclusion about it being a messed up place. Many times these properties stay bad, especially those malls we bought. For 10, 15 years, they've been abandoned and distressed. And so you got to come in under market. Otherwise, you'll be sitting leasing it for 5 years. We deliberately signed 3-year leases because we don't want to sign a 5-year lease for $8 a foot. We want to raise those rents, obviously. But when you do 3-year leases, the banks at the refinance a year later, because we signed those some leases 6 months ago, a year ago. Now we have less than 3 years left. Banks hit us with a debt service coverage ratio because they underwrite turnover. They'll say, look, the probability of turnover is 50, 75%, even though we believe that they're going to for sure renew. And so we got hit by, our loan amount got reduced as a result of this kind of underwriting. And also, they also hit us with 5% vacancy on top of our 92% occupancy. What I'd like to do next in the future is start with a low rate, but aggressively increase those bumps. Not do 3% bumps, but say 50-cent bumps or whatnot. Although it's all circumstantial, obviously, we got to negotiate. A lot of our leases expire 28, 27, 26. Why? Because every time we renew, we can get those rents up to market. And if the market is 12 bucks, and of course we've improved the property, now we have a lot of traffic, it's not a dumpy, ugly asset anymore, what are they going to do? They're not going to go elsewhere for a cheaper price, and they're already established. Now, I'm not going to shove it down their throat. I'm not going to say, pay me or fuck you or pay me. No, we're not going to do that. But we're going to say, look, we've improved the property, we put a lot of money into it. We'd like to get 12 bucks, and they'll say, oh, we want to pay 10. No problem, we'll sign them at 10. So we could exit today and just cash out and go have fun with it. But if in fact we have a nice property, everything is brand new, we have great relationships with tenants, they love us because we've hooked them up. If my market rents are $12 to $14 triple net in the next 5 years, if I can get to weighted average of about 13 bucks a foot, $13 multiplied by 125,000 square feet.
1.625.
1.625.
1.625 multiplied by 95%, please.
1.543.
1.543750.
All right, divided by 8%. Now, of course, rates are going up. 8% might not happen, but I'm an optimist. I'm hoping the rates will drop in the next 5 years.
19.3.
$19 million. So who wants to sell this building for $9 million to make $2 million bucks? Raise your hands. Versus who wants to keep this property, make 27 grand a month cash flow, plus lease all the remaining vacancies, which will give us another probably 15 grand a month, and just kind of hunker down, serve tenants, and stay there and slowly raise rents. And that's, my friends, is the power of value-add investing. At 7.5, it's at $20 million. At 8, it's 18.75 million. And at 8.5, it's 17. And so it's definitely below replacement cost. If somebody wanted to take 15 acres of land and build this today in Holland, if my cost basis is 6.7 million today, and we got to spend another $1 million, let's say, and we sit on it and cash flow it, that right there, guys, deal. I want everyone to find a deal like this, and this one deal will change your life and make you financially free. So, as you can see, things went wrong. Lenders failed at closing, distressed asset, lots of rehab issues, leasing commission and timing risk. Retail demand, everybody's like, oh, retail is dying. 2 or 3 years ago after COVID, we're still kind of dealing with that stuff. And here I am. I raised $2 million. I'm in Minneapolis. This is in Holland. And every now and then I was doubting myself. What if we don't lease them? What if these tenants don't come? Well, it turns out if you invest your heart and soul into a property, if you talk to tenants and try to hook them up, what happens is these buildings represent your energy and who you are and how you serve community. Paul and I, since we did this, bought 3 more properties, and all 3 properties have been very successful. So I asked you guys to give me an IRR. Anybody has come up with IRR? I'll do it myself right now. $2 million investment, plus 32% for 2 years, so $2,640, plus $800,000, right? $800,000 because we were going to sell it for $9.1 million. What I said is, if we were to sell today at 9.1, what would be the IRR to our investors? And so $2 million that was invested 2 years ago would create $1.44 million of profit. So IRR would have been 36%. You guys follow? Anybody has a question how I calculated it? Now, here's the magic. IRR is actually not 36%. You know why? Because we're not going to sell it for 9.1. We're going to sell it for $20 million in 5-7 years. And so here's the magic, right? These guys got their money back, plus they got 16% of their money for 2 years, so 32% total. Everything from now is going to go into what's called a infinity return, because the time no longer works against me and Paul, because they got all their investment back. So all that they get from here is just upside. And so now, if they own 40%, let's say we're at $9.1 million. Let's say we sell this thing for 18 million bucks. 18 million bucks. Let's say we spent 800,000. So we're at 6.6 plus 800,000. So 6.6 plus 800,000 is going to be 7.4. 7.4. So we're going to have $10 million of profit, of which 40% is going to go to our investors. So our investors will receive additional $4.2 million in the next 5 to 7 years. But on top of it, we're going to distribute. Right now, our cash flow is 27 grand a month. We have another 3 spaces available, 5,000, 3,600, 1,650. Oh, and then we also have a jiu-jitsu, which is 3,400, right? So that's a total of 15,000 square feet. So I would say that's another $15,000.
Yeah, that sounds about right.
So basically $42,000 of cash flow if we lease everything and it's 100% occupied building for the next 5 years. $42,000 a month multiplied by 12. That's $500,000 a year. So ultimately, number one goal for me as a mentor here is to educate you guys about what is possible. And this is not one-off deal.